Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. There's, there's a lot of things to cover. You know, there was some decent data that came out. I would say that this mixed something from, neutral to slightly bearish, the bearish side being the builds within pad 3, some of the slowdown when you look at the product demand. And then on the bullish side, we had some decent draws from pad 2. Pad 2 is an interesting one that we're going to talk through. And we want to look at some of these key pieces. And one of the ones that we want to look at when we break it into its 3 different parts. First one is just, the mixed report, why it skews a bit more bearish in my opinion versus on the bullish side. And then summer demand, continues to underwhelm. And this is what we've been saying from the very beginning, was that we were going to see a very sluggish time during the summer, but will it strengthen? And the short answer for us is no, and we want to go through why we think that's the case. And then one of the key pieces that everyone the news is seeing, you've seen headlines where Russia is cutting their production and more importantly their exports of crude, but they're increasing their exports of diesel. So we want to look at, okay, well, if you're bringing down one and bringing up the other, is it net neutral? Is there a balance? And for those that have been following us, we've been saying from the beginning that if they were to reduce their oil exports, we expected them to increase their product exports. And then based on some of these shifts and what we've continued to see on heavy versus light volumes, I should say heavy and light crudes, we want to look at how those differentials are shifting. So with that being said, jumping right into it. So the global crude oil on the water remains elevated. That's going to stay the case, even with some of the reductions that we've seen from both Saudi as well as from Russia. We don't see a huge shift in terms of flows. If anything, it'll likely hold this level now as we go through the, let's just preface this. As long as the Saudi keeps their 1 million barrel a day cut or voluntary cut, you're going to see some of this move forward and not see as much on the water. Some of the problems that we've seen, and we'll talk about this in the last segment. Even with the cut, you have the Middle East that has seen a big increase of floating storage. West Africa is at an all-time high of floating storage, and this is a bigger issue when you start looking at the separation between, okay, well, what is coming in through the system, how much production cuts, but then realistically, what are the export volumes? And we had a call today with one of our clients when they were asking, it's like, look, what is the new outlook for Brent? And when you look at the pricing structure, it'll likely hold that 78 to 82 level, 82 really kind of being the top, but there's still that downward trend because at 82, that's a lot of pain for the consumer. That's a lot of pain for pricing. So even if we see prices go up, we do see that acceleration to the downside when you start looking at that demand side, but with that being said, there's going to still see more and more on the water, just because we don't have as much pipe as we once did due to the Russian restrictions. So now when we look at crude oil in transit, it's picked back up. That typically marries closely when you have crude oil in floating storage go down. You usually see more of it go into transit. So one of the things, and we'll talk about this with the West Africa side, even though they're at a record amount of floating storage, that will come down this week into next, just because we continue to see this some additional flows, some additional discounts, and by discounts, it's still more expensive than it was 2 weeks ago. But it's come down just a touch just to keep some of this volume flowing, and we'll go through that in more detail. But that's why we will see more in transit. More of this crude will end up in both the U.S. as well as Asia. Crude oil and floating storage has come back down. It's still the second highest it's ever been, behind 2020. So it's still very elevated in terms of the floating storage side. And even though when it came down, this move down is really because of Asia. Because on the Middle East side, in West Africa, we've seen an increase, but again, it's just a balancing piece. And one of the big issues when you hear these commentaries, especially from OPEC and the EIA and the IEA, it's like, oh, well, don't worry, because China is going to be ramping up aggressively. It's like, well, They've had a record amount of buying throughout all of 2023. They are up close to, if not over, 985 million barrels in storage, both commercial and SPR, which is kind of one and the same based on there. They still haven't seen a huge increase in exports of refined products. So it's like, so exactly how much are they going to continue to buy, especially when you look at the consumer that continues to weaken? We talk about it in our EIA show. You have industrial activity that continues to come under pressure, is in contraction. You have exports slowing, but yet there's this view that it's like, oh, don't worry, China's going to pick it up. It's like, where? What data point are you pointing towards? I can point to all the other ones on how they've been already buying extensively, well above normal. They've already refilled a significant amount, if not well above what they deem as quote unquote, normal. So they could disappear at any time, especially if prices go higher and say, okay, we're going to go from importing 11 million barrels to importing 8, and we'll pull down that excess from storage in order to keep things. Again, this is something that could happen at any really given month. And at the same time, a lot of this is also, or at least the floor being moved up, is because of Saudi. So Saudi took 1 million barrels a day out of the market. Well, are they going to keep that 1 million barrels a day out of the market, or are they going to bring that back in September? With all that being said, crude had a small draw in the U.S. By 710,000 barrels against the year over year. We're 30 million, 31 million over last year. We're 6.1 million over the 5-year average, which, remember, also includes 2020. When you think about how skewed that 5-year is, we're still well above it. Pad 1 had a build of 560,000. The Pad 2 had a draw of 2.65. Cushing had a draw of 2.89. But realistically, Pad 2, Cushing are still in a fairly normal standpoint when you look at the 5-year. Pad 3 is the one that we've been talking about as the issue. There was a build of 3.96 million barrels. That's 12.5 million over the 5-year. And one of the bigger issues is just how is this going to interact with exports? Because the U.S. produces a lot of light sweet. When you look at the replacement side, Libya is now back online. There was about a shortage. They were offline for maybe 5 total days in terms of impacts of ramp down, ramp up. But now they're back to where they were. It was about 350,000 barrels a day that came off. But from an export perspective, they have storage. So it wasn't like you saw a huge hiccup going in because it didn't last long enough. The CPC does have their planned maintenance. You do have less coming across Iraq because of the CN still not flowing. So realistically, you still have demand going into Europe, but based on the numbers, it doesn't make much sense to have too much going into Asia. They did buy 32 million barrels for delivery in October. So again, we will have some movements, but realistically, the volumes are going to be heading into Europe. And just given where our production is at 12 this is a little low. It's probably close. It's, a little over 12.4 right now. It's just getting stuck at this point in Pad 3. Pad 5 had a draw of 2.12 million. A lot of times that's just driven based on what we've seen with deliveries. And then we had our final breakdown, if you will, in terms of SPR, where there was no additional SPR sales, and we won't have them at this point going forward. So now when we look at the crude oil inventory, here you can see excluding the SPR, we're over where we were in 2019. And as we've been saying, we're going to stay fairly flat at this point in time. And, we really don't see too much movement on the crude oil inventory side, up or down. It'll come down. When you look at levels, you typically have a move down. It's not going to be to the rate of change we've seen. So we'll get draws because we're supposed to get draws. And I think that's the biggest crux of what we try to get across is we're supposed to have draws at this time of year. This is the draw period. It's just they're going to disappoint to the downside when you look at some of these underlying flows. Now, when you look at commercial oil storage and products, as we've been saying, it's just going to go sideways. There's a significant amount of gasoline in the market, especially in Europe. They continue to be at all-time highs. That will, again, compete coming into the U.S. And then it's going to be all about what are the flows, what are the diffs between one and on the gas oil side between east and west Suez, and right now the coming east to west is closed, which is going to support U.S. exports of gas, oil, and distillate into Europe, and that'll help keep some of that balance. But the margins are still really good. So again, even as we ramp up, and we're going to continue to ramp up on the refining side, we're going to be producing a good chunk of that additional product going forward, especially because it has export capacity. Now, when you look at PADD 3 crude oil, this is the second highest we've ever been this time of year. Only other time was 2020, which is obviously a tough comp given what happened in 2020. But it gives you an idea that we have more than enough crude in PADD 3. And the issue that remains, which is, again, something we've been talking about since the Keystone extension was officially, quote unquote, killed, we don't have the right type of oil. And that's really what it comes down to between light sweet and medium, which is typically what we need to run in our, nationwide, especially in the Gulf of Mexico. We have an API run rate that's typically nationally speaking about 33, that has come up over the years. It used to be closer to 30, 31, but as we have added alkylation capacity, topping capacity, and reformers, that's helped us go a little bit lighter, but there's only so much you can run. And that's why we have this disconnect between the crude qualities, which is a big focal point that we've had for years. Cushing, you can see that this is typically the point in time where you have that move down. As we said last week, in the last few weeks, it was going to start moving lower in the rate of change that is kind of similar at this point. And that's where we continue to see it'll start to slow and it'll start to level off here, especially as you have exports, getting hit a bit. And by hit, I mean, it's still going to be ridiculously high. It's just not what it was. And those PADD 2 imports continue to be elevated. Now, when you look at runs, we had a small increase of 60 basis points, as we were saying, 93.7, 94.3. We expect that to continue to move up that rank and get closer to about 95, 96. As we go into, let's call it, peak running for the next several weeks. And here's where you can see that running piece. You can see it kind of flatlines, and then you get that one last push as we go into August. And again, that little kind of flatlining is just because of heat. Obviously it's hot when you're doing a lot of these things because you're using power, you're using heat to crack this crude. So you typically start to get some of the sideline, then you start to increase as you go into August. And then as you get into August, September, and then from the end of September onwards, you go into seasonal turnaround as we go into shoulder season. Then when we look at imports, for those that follow us religiously, if you remember, imports were down about 1.1 million barrels a day. And what did we say last week? Should expect a big reversal, and here it is. Again, this is lumpy. We had an increase of 1.295 million barrels a day of imports. PADD 1 was down 219, but everything else was up. You had PADD 2 up 291,000 barrels a day. PADD 3 up 648,000. PADD 4, PADD 5. PADD 5, and the one thing that we talked about is PADD 2 is going to stay elevated because of that drawdown from Canada. The WCS spreads got a little bit better. They're still expensive in comparison to history. That's, going to remain the case given the tightness in the heavy market. PADD 3 needed a nice refill, especially given the need for that disty cut, that heavier crude. So that's going to stay a little bit higher. But remember, we've been saying that we should have seen some of this increase, and we weren't really seeing it. So there's a bit of a makeup number in there as well. So most of the ones that were up will be down this week into next week. It's just they won't be down as much just because we're starting to get into that core run rate period. So PADD 2 is going to stay high. PADD 3 is going to stay at about that 1.4 million barrels a day, and then PADD 5 will stay lumpy, so that will likely have a sizable drop off next week. Pad 3, here's what we're talking about. We thought it was going to get closer to the 5-year average. Here you can see it just went above it. So again, it'll pull back down. It'll stay at that, and in the lower end of the cloud, just a bit closer to that 5-year average that we were expecting. Pad 2 had the bounce back up. It's going to stay elevated well above the 5-year average, which we see as being the case. Implied demand, gasoline disappointed us a bit. We were expecting to be a bit closer to 9 million at this point. Instead, we were at about 8.85. So you can see it's still below the 5-year. That's going to continue to grind up. We're going to get to that 9 million, 9.1 million over the next week, and then we'll likely settle out at that 9.2, 9.3 million barrel a day. Probably not getting to 9.4, given just that kind of sluggish start, and then some of the commentary that we've heard and that we'll talk about in the next segment as it relates to the U.S. Distillate had a nice bounce of 700,000 barrels a day. For those that watched us last week, we said that there should be a bounce. 2.96 was just a bit too low. Realistically, we'll settle out something closer about 3.3, 3.4. Jet, as we said, 1.55, 1.65, right in line. Propylene had a bounce of 290,000, but you could see it's still very low, and compared to the 5-year and the year over year, and a lot of that is driven based on the weakness in the petchem side. Implied gasoline, the only time we were here was 2020, and as you can see, 2022. So very. Everything is a bit shifted because of where July 4th fell. So, you could see kind of where things are. So we will get a bounce, but as we were saying, it's going to be a bounce to that average, that blue line. And we're just not going to get to where I think the market was expecting, which is closer to what is quote unquote normal, or the average between that 2017, 2019 period. Instead, it's going to be a bit disappointing. And a lot of that is driven based on price, based on pain at the consumption level. And again, we'll give you some data on that going forward. So days of supply, again, fairly normal, not too much there. Gasoline storage, hugging that 29-year average. You can see it's following the curvature of it. So it's not, the rate of change isn't bullish or bearish. We were expecting to see a more bearish build. We haven't gotten it. The imports have still been a bit more sluggish when you look at some of the different flows. But again, we do expect to see that increase, and we do expect to see unseasonal builds, especially as demand remains light and imports continue to flow into the market. Distillate, it's, even though we had a build, you can see that as a rate of change goes, it was a disappointing build. This is going to support crack spreads. This is, again, going to keep guys running hard, especially when they can get their hands on the heavier barrel, because we are still on the low end when you look at storage and you look at the setup, especially when you break it down between obviously pad 1, pad 2, and pad 3. Jet continues to trend higher, again, that balancing act that we've been talking about. And then when you look at the curve, the curve is about even, it's in slight backwardation, but you can see it's starting to level off. We'll likely have some flat pricing as we get into the end of the day. Crude has fallen off a bit. It's still positive, but you can see it's, again, getting towards that flatness without too much adjustment. And we don't see, based on this data, what just came out, even though we said it skews a bit bearish, it's not like you're sitting here saying, oh, it's terrible, therefore Brent, WTI shouldn't be 76, it should be 74. It's like, no, it's just kind of blah. It'll drift. If I had to do anything, am I a buyer or seller 76? I'm more of a seller, but I'm not a seller where it's like I'm shorting at 76 because this data was so bad. I'm gonna cover at 72. It's like, no, maybe it goes from 76 to 75 and a half. Again, I wouldn't be buying crude on this data, especially on some of the numbers coming up. Floating storage ticked up a bit, again, supporting, as we were saying, a bit more increase of imports, which, again, that's that timing delay that we've been talking about. So we do think this is supportive of some of that additional heavier crude. Not that we're going to stay above the 5-year average for imports, but it's just going to keep crude moving through the system. So that's what we have for you on the summary side. In the next segment, we're going to go deeper into the U.S. and some of the U.S. impacts that we've seen so far.